And now that we've got Liz here, I think we can start to kick things off. How you doing, Liz? Just want to make sure you can hear us all right and we can hear you.
Yeah, hi, Jackson. Doing great, thanks.
Beautiful. And thank you to everyone in the audience, Noah, Jackson, Matthew, Cody. We really appreciate you guys being here, and those of you listening to the recording. This is our weekly whole life Twitter space, bi-weekly whole life Twitter space. We hold a weekly Twitter space, but we alternate topics with our real world asset tokenization Twitter spaces and what you're seeing now, which is our whole life insurance Twitter space. We're very excited to have you. We have a really, really exciting panel lined up for you on the most common problems in life insurance that have been sourced from our proprietary AI Bob, which is an LLM model based off of Dr. Robert Murphy that you see here co-hosting this with me. So it's a pretty fun section we've got planned. And so I guess without further ado, you guys want to do quick short intros for people that may not have listened to any of our prior spaces? That might be a good idea before diving in. And then Dr. Murphy, I'll let you take it from here.
Okay, sure. So yeah, just real quick intros for the team here. So I'm Robert Murphy. I'm the chief economist here at Infineo. I have a lot of background working in money in banking, but then also in life insurance, the mechanics of specifically whole life insurance policies. And that's kind of my area of expertise. And I'm going to act as the MC of this discussion, this Twitter Spaces. And I'll turn it over just so you can hear from our three main panelists who are going to be the experts that I'm going to be eliciting wisdom from.
All right. Hi, everyone. Happy to be here. George Roth. I'm the director of our Infineo agency here in Canada, and I've been licensed for over 16 years and practicing and teaching infinite banking concept and the powerful life insurance when properly structured for over 14 years. So just happy to be here.
Hi, I'm Liz Lamond. I work with Infineo and I help people put insurance in place and teach them about the power and value of cash management with whole life insurance. So it's a super powerful tool and can be applied in lots of different ways. And so by speaking about what I'm doing myself personally, as well as, working with lots of clients over time in lots of different scenarios, I enjoy, meeting with people and customizing solutions that work for them, whether they're business owners, investors, or just setting something up for their families. So, yeah, excited to have the discussion today about the power of this tool and how it could potentially assist some of our listeners.
Thanks, Liz. I'm Wayne, and I also work with Infineo, and I've been at this for about 35 years, been a licensed life agent for about 35 years. Very, very passionate about helping Canadians and Americans and potentially the globe understand the importance of capital and the preservation and protection of capital, and then the ability to leverage that capital and storing it in a structure that allows you to seize upon opportunities and grow your wealth and benefit your family and loved ones. So thrilled to be here. Particularly thrilled to be working with this team.
Okay, thanks, everybody. So let's dive right in. And just to give some framing of what the content of this particular episode or installment is going to be, we are using, we're fielding sort of standard questions that people might have when they're applying for life insurance or wondering, gee, do I have enough, that sort of thing. We first turn to AI Bob, which is our proprietary basically clone of myself that it's using, a large language model and then augmented with company specific information we fed into it, about the mechanics of whole life, a lot of my writings and things like that, other things from the industry that we plugged in. So that's what we used to generate the list of questions. And then we threw in some other ones as well. So that in case you're trying to wonder what the time of the title, but last thing I'll say is a caveat or a prefatory remark. So we're going to be fielding some standard questions, but through the lens of the fact that our three experts here have a long history of providing what's called infinite banking type policies, where Infineo, the way we described as cash management with whole life. And so some of the answers that you're going to hear from our panelists may differ from if you just asked, some other insurance agent that you got from some other company. So that's what we're doing here. We want to give a mixture of stuff for newbies, but also people who have been doing infinite banking for a while, so you can understand. So the first question we want to address is, I'm curious to hear from our panelists, when you meet with a new client or prospect, how do you determine just at the outset how much coverage they should have? Or maybe alternatively for the people listening, if they know right now, like, oh yeah, I got a policy that's got this much, like, how do you determine for a given family, how much life insurance do they need?
All right, I'll kick off that one. So the first thing that's very important to understand when working with the client is, what is the purpose? So what is the purpose of the insurance? What are their objectives? What are their goals? What is their cash flow? What do they want to accomplish, and when do they want to accomplish it? So once we have that kind of information available to us, we do what's called a needs analysis. So we have to determine how much insurance this individual or this family or this business actually needs to cover expenses. So expenses like the replacement of income. So if a family or a company loses an individual who's providing the income, what is that impact going to be? And how can they carry on with that financial loss? We also want to cover off any kinds of debt that they might have owing, final expenses, future children's education. So really we want to look at what do we want to pay for when that person is no longer with us? What do they have available to them? How much insurance do they have currently? And then we will determine what is left over as a need. And that will guide us in providing options and solutions for them. Anyone else want to jump in?
Yeah, I think you answered that really thoroughly, George. I'm just going to sort of give a bit of context, for people just to kind of think about it in terms of when we're talking about insurance need. You think about it in the context of if we use an example of, say, car insurance, right? Looking at what is the, if something happened to your car, what is the amount that you would need to kind of be able to be back on the road driving, doing all the things that you were doing in terms of, and not lose value in terms of that. So that's why, if you think about all the things that different people contribute to a family. And so I think just an important point to say in that is, even in families where there might be one person who is not necessarily the main income earner, there would still be a significant need for insurance should something happen to that person because of, the implications on the family, quite aside from the obvious ones of the loss of that person. So insurable need goes sort of beyond income at times in terms of like the other things that George also mentioned, but also, that's why we need to look so thoroughly at what the need is for the family and not just beyond sort of income and assets in every situation.
Okay, Wayne, did you want to jump in, or you want me to move on to the next question?
Yeah, I think they've done a great job with that, Bob, so I think we can move on.
Okay, great. So thanks. So now the next item that I think we should maybe talk a bit about is, so when it comes to the nuances of understanding whole life, I know that one of the issues is the fact that for a given amount of coverage of death benefit, it's more expensive to have a whole life policy than it is to have a term policy, particularly if it's a shorter term policy. So can you guys just speak a bit to, what principles do you use? Like, would you ever meet with a particular client and say, ideally you should have such and such amount of total coverage, but given your income right now, you couldn't take out a whole life policy that's that big. So why don't we have the first 10 years be a term of such and such? Or anyway, just I think you understand the issue I'm raising. So can you just speak to that? Do you ever work term into the mix depending on the client?
Maybe I'll jump in on this. So as clients are looking at putting protection in place for all kinds of reasons, as Bob pointed out, whole life insurance can feel a bit more expensive in the initial stages. So we may augment that using a term rider, adding some term insurance. But one of the things I like to spell out to clients, and my colleagues can maybe speak to this as well, but term insurance is designed to price itself out of the marketplace before you turn 85. So only they say about 2 to 3% of term policies ever pay out because they do get increasingly more expensive. But they are a really great starter place to get people started. But if we understand the proper process, we do want the permanent insurance to be there to protect our loved ones throughout our entire life without it becoming cost prohibitive. We also, if we understand how to utilize an existing permanent or whole life insurance policy, we can cash flow, which is really what Infineo is all about, is helping clients understand how to cash flow with whole life. And so really, at the end of the day, if you take the time to learn and understand and apply and efficiently leverage, you're going to actually get your insurance virtually for free. All your capital is going to come back and be available to you throughout your lifetime for use. And at the end of the day, you've got this incredible death benefit thrown in as a bonus. That's kind of how I would look at it. Term has a place, but term is a temporary solution to a permanent problem, and we need to understand that.
Yeah, well said, Wayne. I agree with everything you said. I would just add to that, absolutely term has its place, but the problem with term is that the term expires. And once it expires, you have the option to renew it. However, it's going to be at a much higher cost. So that's, and it expires, before you can use it, right? So it's designed to expire before you do. That's why so few actually pay out. But it does have a purpose, and we do often use a term rider with our permanent policies. The other thing I'll say is, people question the price or the cost or the premium of whole life. Cost is only an issue in the absence of value. Something that my friend Wayne Durksen says all the time. So I'm going to steal his words. So that's important. Cost is only an issue in the absence of value. So what are you getting for your dollar? If you know with certainty that you're going to get out more than you put in, when would you stop putting money in? That is the power of whole life, and then we can augment that with the term rider as appropriate. So no one size fits all. Every solution that we develop is specific to the client and their needs and their family's needs or their business's needs. So that's also very important.
It's a bit of a mic drop moment, George, but so I'm not really sure how to go after that. But one thing I just did want to add in is that some people may not be aware that whole life premiums do not go up like term life do. If when you renew a term insurance, you're usually either 10 or 20 years older. And so the premiums for the same amount of insurance are going to be more expensive. One of the unique features and interesting things about whole life insurance is that the premiums do not go up. So whatever premiums you're putting in today will be the same even as you age. So you have flexibility in terms of the amount of premium you put in, but those premium amounts do not go up every sort of 10 or 20 years like they do with terms. So I think that's an important distinction when we're talking about the things that Wayne and George mentioned in terms of, what the value that you're getting, and also, the permanent problem, so that it remains affordable and reasonable, and that you get to keep the insurance in place for the whole of your life.
Okay, thanks, everyone. Yeah, let me just add to what Liz just mentioned there, that the one way to think about this is that, the conventional approach, often people, especially if you listen to critics of permanent life insurance like Dave Ramsey or something, is they'll say, oh, look at, you can get the same coverage at a fraction of the cost using term policies. Why would you dump your money? And that is an incredibly misleading comparison. And just to elaborate on what Liz said there, just think of it this way. So imagine a 30-year-old, and I go through examples like this if I'm giving seminars on this stuff. Imagine a 30-year-old. You can even do this on your own. Just go and look at an online price quote or something from a life insurance company. You can get it on the internet and just say, okay, put in whatever you want, $500,000 of death benefit coverage. And then what's the premium for, if you're 30 years old, for a 5-year term policy, meaning, you pay a fixed premium every year or every month for those 5 years. And then after that, the policy goes away and you don't have coverage anymore. And then do the same exercise for a 10-year policy and a 15 and a 20 and up to a 30-year term policy. And you'll see that the level premium, the amount you have to pay every month or every year, depending on how you set it up, for those policies that I just described, goes up over, the higher the term, the longer the term is, the premium's higher. And so, when I ask the audience, why is that? And everyone knows, well, because if you're a 30-year-old, a 5-year term policy, you're only 35 years old when that thing expires. So they don't need to charge you very much because chances are you're not going to die before you're 35. But if you're a 30-year-old and you take out a 30-year term policy with the same death benefit coverage, they have to charge you a lot more, obviously, because now if you keep making those premium payments, the insurance carrier is on the hook up through your age 60, and your mortality rate is much higher in those later years than it was when you were 30. So obviously, for them to even break even, they have to charge you a lot more than they did just for the 5-year term policy. Okay, so that makes perfect sense. No one's worried that life insurance companies are ripping people off by overcharging on a 30-year term policy versus a 5. That's just, the actuarial mechanics, obviously. Well, a whole life policy, if you're 30 years old, means that as long as you keep making your premium payments, you don't lose your coverage. It's in force for your whole life. That's why it's called that. So in a sense, if you're 30 and take out a whole life policy, that's like having a 91-year term policy, right? And so if you just sort of extrapolate and see how the premiums change when you go from a 5 to a 10 to a 30-year term and how the premium goes up, if you then said, well, what about a 91-year term policy, which is in a sense kind of what a whole life policy is, it's not shocking that the amount you pay for the same amount of death benefit coverage is higher because you're getting so much more. Okay, so that's I think one way to think about it. So it again, just the underlying actuarial mechanics of it, the reason they are more expensive is because you're getting so much more value. Just like a Ferrari is more expensive than a Honda. Okay. Also, let me just mention before we move on to the next question here, issue, there's a pinned tweet. If you're hearing this and you want to talk to someone from Infineo about your particular situation, again, no obligation, but just to have a free consultation, just to throw some numbers and see what would something like this look like in my situation, there's links there at the pinned tweet if you want to check that out. Okay, the next topic we'd like to turn to. So given now that we've explained, the difference between term and permanent insurance, we keep talking about whole life, but actually, if you're familiar with the industry and how it works, there's different types of permanent life insurance. Specifically, one major distinction is between a whole life policy versus universal life, or UL. And so here at Infineo, we have a strong emphasis on whole life, and that's what Nelson Nash, the founder of the infinite banking concept, strongly preferred. So can you guys speak a bit to why do we have, why is whole life better for cash management purposes than a UL policy? And why are we, what does the standard agent who would use a UL, what is that person missing? What do we know that they don't know?
Sure, I'll tackle that one to start. So I think it's important to highlight 3 guarantees that come with whole life insurance. So the first guarantee we've already talked about, the premium is guaranteed never to go up for the entire lifetime of the life insured. So that is incredibly important to understand. The premium never goes up. So once you lock in your price point at your current age, as you grow older, the cost never goes up. The second guarantee is that there's a cash value that is growing inside that policy that you can access. It is guaranteed to always go up. It cannot go down, and it can never be zero. So it must, guaranteed by contract, go up in value. The third guarantee is that the whole life death benefit is guaranteed for your entire life. It will never go down. But when policies correctly, that is actually going to go up over time. Not necessarily guaranteed to go up, but it will go up if the owner of the policy does the right thing. So those 3 guarantees are incredibly important. So if you want to grow your capital, as Wayne mentioned earlier, we want to grow and protect our capital and then put it to work for us. We want to have some guarantees that money is going to be there when we need it and when we want it. Universal life, on the other hand, is not guaranteed. So any amount of money that you put in addition to the premium goes into an investment. And then you are purely at the mercy of what you've put that money into as an investment. The markets will dictate how the performance of that investment. So think of it like this. So universal life, the risk is taken by the insured/owner of the policy. Whole life, the risk is on the insurance company because they are providing guarantees to the policyholder. So they have to take all the risk and make sure that they can make good on their guarantees, which they do. Insurance companies have never missed a dividend in their history, the companies that we work with. So those are kind of the biggest differences between UL and whole life. Where's the risk? The risk lies with with the policyholder or with the insurance company. Where do you want to put your risk and what risk are you willing to take? Go ahead, someone else.
I think if I could jump in as well, George, and I appreciate your comments. Universal life, really, if we understand the history, was a reaction to a market correction or massive change. And the only people that didn't react was the whole life insurance companies. They just stayed steady to their game plan. They execute the game plan as they have been for 175 years in Canada and beyond that in the U.S. Universal life has volatility to it. And when it goes to growing your capital, protecting and preserving and growing your capital, every time you leverage a universal life policy, your behavior affects your capital growth. Inside a whole life policy, the exact same behavior drives your growth. And so they have very different behaviors and too complex to explain in this moment. But it's worth taking the time to say, explain that to me. What do you mean by the fact that my universal life policy, when I leverage a loan, actually hinders my growth versus the whole life that actually, maximizes my growth? And I think it's a pretty significant difference.
The goal of what we're trying to do is use the whole life insurance as a foundational asset. So, obviously either way, the protection piece is in place. So that's obviously very important, but really understanding, like, sort of back to your original question, Bob, is, what is the goal of what we're trying to do here, and why we recommend it is thinking about what the objective is we're trying to achieve. So we really want something that has guarantees and growth that you can use as that foundational asset, so that you can then sort of have something that you can go and achieve other objectives with. And the challenge with universal life has been outlined by my colleagues is you don't have those same guarantees. So it doesn't meet the objectives and purpose of what we're sort of trying to do with this asset as well. And it also requires, UL to be, depending on the type of UL you get, but it does require a lot more active kind of management of it. And as George mentioned, the risk with whole life is with the insurance company. They're basically actively managing and making sure that those guarantees are met. And so that then frees you up to be able to focus on other things because those guarantees will be met.
Okay, thanks everyone. Yeah, if I could just elaborate a bit on that. So I'm not in production myself.
I think really quickly as well, on the UL side, there's a lot more fees involved with UL than with whole life. So essentially whole life, there are no additional fees that are charged for the use of your money, whereas UL policies have a cash surrender charge if you access your money within the first 10 years in most cases. The other thing with UL that is important is, again, depending on how it's structured, it will often go up each year. So it is a yearly renewable term, meaning that it's a 1-year term that keeps renewing each year automatically. However, the cost is going to continue to go up each year, just like with any other kind of term policy. So those are also important features about UL as well.
Yep. Thanks, George. So yeah, folks, just to give a little bit more of the historical context and it'll help understand the distinction. So in the '70s, particularly the late '70s, early '80s, so originally permanent life insurance was whole life. That's just what the industry standard was. If you didn't have a term policy, you had a whole life policy, and a lot of households saved inside of a whole life policy. Like that was just a standard practice. But then in the U.S. experience with the inflation of the '70s, there were a lot of complaints that the carriers, they had bought a bunch of bonds before the inflation was really kicked in, and so then when inflation took off, the policies were sort of left behind for a brief period where before the portfolios turned over. So there were people that were upset about the performance of their policy. I would blame the Federal Reserve, but be that as it may. And so the point of universal life insurance, I think partly they chose that word to mean like, oh, we're giving you flexibility. Like, you can do all sorts of things with this. Hence, it's universal. Like you can, as you pay down your mortgage, you can scale back the death benefit if you want to, because maybe you don't need as much insurance. Or if you want, if interest rates are higher, then you can not pay as much in the premium. So it's up to you. Whereas the whole life, it was kind of like fixed factory settings. Once you take the policy out, it just chugs along. And so, that gives more flexibility to the customer. But the point is, for using it as a cash management tool, that's not good. You wouldn't want to open up a checking account and the bank told you, okay, you put $1,000 in there right now, your balance is $1,000. Next month, if you want to know how much is going to be in my checking account if I don't spend anything, well, it depends how the stock market does. That wouldn't be a good, that wouldn't be a good checking account. So maybe you do want to invest in the stock market, but that's a separate kind of thing than your checking account, right? And so likewise, if you're relying on permanent life insurance, not only for death benefit coverage, but also, the living benefits of this cash management vehicle, you don't want a bunch of uncertainty built into that. If you want to go invest in something, then you can take out a policy loan and go ahead and do that. As Nelson Nash always stressed, a whole life policy is not an investment. You're not investing in life insurance. Okay, so anyway, if that helps clarify some of the mentality. So, I'm not here saying, oh, UL policy is bad. It's just, it's not appropriate for the kind of thing we're talking about here when we say using it not only for death benefit coverage, but as a cash management vehicle. Okay, so moving through our list here of topics. So now we've established, okay, this is why, we have a preference for a whole life policy. But even there's a lot of different ways of setting these things up. So for example, just 3 different types. You could have a whole life policy that's a so-called 10 pay, where the contractual premium you got to pay for, 10 years in a row, and then it's paid up after that. Or maybe there's a policy structure that's called paid up at 65. So the person, depending on how old they are when they take it out, when they achieve age 65, that's the last premium payment they have to make. Or there's other ones, like in the U.S. called an L121, meaning you pay level premiums up through age 121, if that's how long you happen to live. And at that point, if you're still alive, they just go ahead and pay you, the face value of it. That, if you live to be 121, you win the race. And even though you're still alive, you get the quote death benefit from your policy. That's how they're structured. So I'm wondering, can the panel chime in on, what do you, which of these kind of structures do you use? Does it depend on the client, or do you just have a personal favorite that you always go to? Can you just speak to that?
Sure, I can speak to that. My apologies there, Dr. Murphy, if I stepped on you. I lost sound, so I didn't know that you were talking. Sorry about that. So it totally depends on the client, right? It depends on the needs and the desires and the priorities of the client. We can offer a 10 pay, a 20 pay, a life pay, a pay to age 90. So there are many different options in how long the payments can last. But it really comes down to what is the client trying to achieve and what are their timelines. I know one thing that Nelson always taught us, and it's always stuck with me, is if you know without a doubt, with certainty, that you're going to get out more than you put in, when would you stop putting money in? So if I think of myself going to my bank and I have my bank account and I can take out 12, when would I stop putting in $10? So that's certainly.
I think we've lost George's sound again. So I just jump in and say, yeah, I think, along the theme of what he was saying, it does vary depending on the client. The other thing that I like to talk to people about as well is that none of us have a crystal ball. So I want to build in as much flexibility as I can. So George was speaking about, if you're building something really efficient, when would you want to stop putting money into it? So we also don't want to create limitations for clients either. So, but we want to give them, give them options in terms of what they can do. So generally we, prefer to give people options with a life pay, because there is the opportunity to offset it at some point, which means, wouldn't necessarily have to keep putting premiums in, but people may choose to want to do that, and their financial circumstances may change in terms of what they want to put in the policy. So those are all considerations. There are reasons why we would use a 10 or 20 pay in certain circumstances, but in a lot of circumstances, the flexibility of a life pay or pay 90 or whatever it is, depending on the carrier, usually gives people a lot more flexibility. Maybe you can add to that as well, Wayne.
Yeah, I think that's all been well said. I do think that part of our challenge and opportunity is to educate clients on what's actually happening. And once you see it, you cannot unsee it. And therefore, money is always in motion. And a lot of times we would think, well, when I no longer have an income from my career, I don't want to be strapped with these payments, with these ongoing obligations. That's where the flexibility comes in, but also education. Money must reside somewhere. Cash is always in motion. And so understanding some of that and applying it and saying, well, show me the math. And once we start to see the math, we start to realize, you know what? I might change my perspective from why don't I do it for 10 years or why don't I do it for 20 years to why don't I do it for life? Show me the flexibilities and show me the advantages. And again, the client gets to decide. I mean, our job is to coach and educate and assist. But understanding what's happening, you will almost always know what to do once you see it.
Okay, just to give the listeners something more tangible, perhaps, can you guys give an example, like what kind of a client would you say, oh yeah, clearly I would recommend to this client, you want to have, pay through your whole life kind of premium structure versus a different kind of client where, it's a 10 pay actually might be appropriate here. Like, would the latter be like an older person who maybe just sold a business off and they have this big pile of money that they want to put into a life insurance policy over time? And so, they don't really want to be on the hook for the next 30 years, but can you just give it doesn't have to be all three of you, but can somebody just give an example of two different, typical client types that one design would be appropriate more versus the other?
Do you want to jump in on this, Wayne? Or?
Yeah, I mean,
can you hear me okay?
Go ahead, George.
No, go ahead, Wayne. Sorry.
Yeah, so one of the things I often say is my optimal client is 21 inches long. Give me an infant and I can build wealth or help that individual build wealth. And so I'd say, boy, fund that thing right through for life. Help that child learn how to use it, help them learn how to cash flow against it, and then help them understand it's a really great place to store capital that they should be doing for all of their life. But, as Bob mentioned, there are circumstances. We do buy-sell agreements. We do key person insurance. We have employees. We have all kinds of situations where we would apply these. And we might say, in my situation, I'm insuring my own life and the life of my business partners. We're also insuring a bunch of our employees. And so on that basis, we might say, I'm not going to fund my employees for all of life. I'm going to fund them until they would logically sort of start wrapping down their career, maybe at age 60, 65. And so there's all kinds of reasons why we might do something, but understanding the math and understanding the cash flow and the death benefit and what's actually happening, we don't want to make premature decisions without adequate information. But once that information is there, we might say, yeah, I'm only going to insure my employees till they're 60 or 65, my business partner maybe for life, my family for life, my kids, my strong statement here for sure for life, because they need a place to stick capital and they need a discipline, and that'll serve them well in life.
Okay, George, you got to chime in?
I was just gonna just add that real quick. So the 10 pay and the 20 pay, really what you're doing is you're prepaying for that policy. So the cost per month and the cost per year is going to be higher, because you're only paying for a certain period of time. So, and every one of these options has pros and cons. So, we sit down with our clients, we understand their situation, and then we offer options, and then we give pros and cons. And then ultimately the client will decide what makes the most sense for them.
Okay, great. So, why don't we move on? So, by the way, folks that were listening, just as you can see, even just saying like, oh yeah, I like whole life. I want to use it for the living benefits as well as the death benefit. There's a lot of moving parts, a lot of bells and whistles in these things, even a quote plain vanilla whole life policy. And so that's why, again, if you're interested, you need to talk to somebody who's been trained in this philosophy, this mindset, and who has experience doing it. So again, the pinned tweet, if you want to talk to somebody at Infineo, you can go ahead and click on there. There's 2 links depending on whether you're from Canada or the U.S. So yet another complication or nuance in this discussion is, okay, even given, that I'm going to have a certain policy that's like a 10 pay or L121 or what have you, there's also a distinction between the base contractual premium versus what's sometimes called like an LPUA rider. And so the PUA stands for paid up additions. And so it's a way that you can build in on the front end, the capacity, the ability, but not the obligation for you to dump in more premium inflows at various points that buy you a bunch of paid up insurance. So it's like a one pay mini policy that's appended to the chassis of the underlying, standard policy, if you will. So that's maybe one way to think about it in terms of what the heck is this. So can you guys speak to, how do you structure that sort of just, if you realize, the client wants to put in $10,000 a year, what mix do you recommend for like the base versus the PUA?
I think it's really important that we emphasize, one size does not fit all, and we're not going to situate any kind of a solution until we fully understand the client and the client's needs. So part of that comes into how much base, how much PUA, paid up additions, and in Canada we call it deposit option. So it's an option to overfund your policy, and then those dollars go directly towards growing the cash value and the death benefit. So that is the best way to grow the cash and the death benefit faster, more efficiently, more effectively. But it's an option. So that's also where flexibility comes in. So we set these up so there's a minimum payment, there's a maximum payment, and you can put in anything in between. And you can change your mind, and you can change from monthly to annually back to monthly. So there's a lot of flexibility that we build in, but it's important to know, what are we trying to achieve? What are our timelines? What are our objectives? And what is it going to take for me to meet that objective? The more I put in, the more I get out. I put in pennies, I get out pennies. I put in dollars, I get out dollars. So that's what Nelson taught us. That's how it works. The more you put in, the more you're going to get out. And then those paid up additions, those extra chunks of insurance that you're purchasing, are also earning you dividends. So the dividends are compounding upon themselves as well, and contributes to the growth of your policy.
So much of what happens inside these structures is driven by your behavior. And so I don't think we have time to get into this, but if we ever did have time to get into it, Dr. Bob is the right person to be on the call. But you think about this as a partial hedge against inflation. You're using present day dollars to buy up paid up additions that are going to grow and grow and grow, which is very significant. And so again, it's your behavior that's going to actually drive the performance of this, largely drive the performance of this vehicle.
Yeah, one of the other considerations, I know it's a little bit different in the US, would be around the MEC limit, and I'll let Bob speak to that. But, certainly also looking at what design makes sense in terms of the objectives of the client. And we need to consider all the factors, right? What is the client looking to put in? How long are they likely to put in these extra paid up additions, deposit options? And therefore, that's going to drive the design, because understanding that we want to make sure that even if they are not putting in as much in terms of deposit options or have breaks in those, that we want to make sure that the policy is designed in such a way that it's still growing very efficiently for the client, so that they're getting the best result from the dollars that they are actually funding into the policy. So those are some of the nuanced pieces in terms of looking at what is the optimal design in terms of, as you mentioned, the percentages, Bob, of, base versus paid up additions. And as Wayne alluded to, in terms of client behavior, what is the likely scenario in terms of what is actually going to be funded, and that will, to a certain extent, determine the design as well, just to make sure that policy is really efficient and grows to the way that the client would intend to use it.
Great. Just to give a little more detail too, just going along with what everyone was saying. I forget whether it was, I think it was George who was talking about how it affects the cash value. So one of the distinctions, and this is why our panelists are suggesting that it really depends on the client and what they're trying to achieve with these things. That, for example, if you could have two identical people and one of them is paying $10,000 a year in a policy that's just 100% base and there's no PUA component, and another person is also paying $10,000 a year into his policy, but it's 50% base and 50% paid up additions. And so technically the contractual base premium on that second policy is only $5,000. And then there's an option to kick in an additional up to $5,000 of a PUA. And suppose the person in practice does choose to do that up to the maximum. So they're both kicking in $10,000 a year. So the difference between those two scenarios, the second one where half of it is in terms of a PUA contribution, the available cash surrender value is going to grow much more rapidly in that second scenario, right? So the person, even after so that they first put in their first check for $10,000 in year one, as soon as that clears within, the next few weeks, there's going to be a sizable amount of money available to borrow against. Whereas in the first scenario, the person pays the $10,000 first annual premium, let's say, there's not going to be much available to borrow a month later. Okay, so you might say, all right, well then, why wouldn't I just dump as much in the PUA as possible? Well, because another difference though is if you look at how much death benefit coverage do you get in those two scenarios. If the people are the same age and have the same health rating and everything, the first person, if he takes out that policy that's a $10,000 annual premium, is going to have a much higher face death benefit coverage. Okay, so that's just one example of one of the trade-offs involved. And for the purposes of this Twitter space right now, we can't get into why that is, but I just want to explain that's why, again, there's pros and cons, I think George said, of either approach. And so it just depends what do you want to do with this thing. If you're primarily wanting to be able to access your money in terms of borrowing it right away, it's one thing. But if you're taking it out on your child who's a newborn and you just want something that's in force for them to use when they're 25, then maybe you want to lean towards more of a contractual base. Okay, so here's one I'm curious to hear your guys' thoughts on. Since I'm not in production myself, I don't really know this, but I'm curious. So you meet with a client and they have a projection, what's called an illustration in the original contract that's appended, where it says, okay, yeah, you're going to take out this policy and you're going to make these premium payments, and here's what it'll look like 10 years from now. And we think that, they're not guaranteed, but we think the dividends are going to look like such and such. And so, you can probably think you're going to have this amount in cash value and this amount of death benefit 10 years from now, 20 years from now, and so on. So I'm wondering, for you folks that have been doing this for a while, what is your experience? What has it been, with your actual real world clients that you've had for a while? Like, how do their policies actually perform vis-a-vis what they thought they were getting at the outset?
Yeah, that's a great question, Bob. Again, it depends. So I have seen performance be greater than projected, and I've seen performance be less than projected. So when we do an illustration, the insurance company is projecting out using the current dividend scale. So their current dividend in this year, they project that out over time. So we know that it's not going to stay the same. Dividends will go up, dividends will go down. And there are many factors that go into what that dividend is going to look like each year. Ultimately, it's based on the profitability of the company, if it's mutually owned, and then or the profitability of the participating account, if it's not a mutual owned company. So depending on the performance and the profits, each year the company pays out a dividend to participating policyholders. That's what participating means. That means you're participating in the profits of the company and or the participating fund. So we earn dividends. Now, those dividends are not guaranteed, and we don't exactly know what they're going to do in the future, no more than we know what the market's going to do in the future. But dividends have never been missed in the history of these companies. So that's one good thing. Even though it's not guaranteed, they've never, ever missed a dividend, ever. Through the Great Depression, through the World Wars, through all the recessions, et cetera, et cetera. The other thing is the standard deviation on what insurance companies do with their investments and the dividends that they pay is very, very small. The volatility is very tiny. They smooth out those results year over year. So the standard deviation is like 1 to 1.5%. So it's extremely small. So yes, it's not guaranteed, but it's very, very certain. And historically, it's never been missed. So that's kind of the difference. If you compare that to an illustration provided by a UL policy, you're predicting a growth percentage based on nothing, right? It's pure speculation. Whereas this is not guaranteed, but it's very, very probable, if not certain.
Okay, Liz or Wayne, did you want to comment on that, or do you want me to move on?
I think the only thing I would add, Bob, is that in my experience working with clients is that quite often when we look at the performance, say, where are we in relation to where we thought we would be, we're remarkably close, even without them really leveraging the policy the way it could be. So, yeah, I just think it's really a great opportunity.
Yeah, I'd say the same as George and Wayne. So a little bit of fluctuation. I mean, in the original illustration, they do provide showing, what happens if the dividend scale changes. So it's within the ranges that have been projected at the beginning.
Okay, great. Here's an interesting topic that was suggested. So I think it was Wayne mentioned earlier, we're talking about the different policy designs and was saying, well, if you were doing like a buy-sell kind of arrangement, wanted to have a policy in place and so forth, or if it's key man insurance, things like that. So in general, suppose someone listening right now is, let's say, a small to medium-sized business owner, and they're realizing that, oh yeah, maybe my business, I have a line of credit at a conventional bank, and I tap on that depending on the seasonality of my business, and I'm starting to see the benefits here of maybe building up one or more of these whole life policies properly designed for cash accumulation, so that instead of being reliant on the whims of the commercial bankers, I've got this alternate source here that I can turn to. In that kind of scenario, should the person, should the business be the owner of the policy, or should the individual, as a person, take out the policy and then make loans to the business? Do you guys have any thoughts on that?
When I'm working with business owners, we're focusing on where is their main cash flow coming from, right? So in terms of generally the cash flow is happening within the business. So, it wouldn't make sense to fund a policy outside of the business, take money out of the corporation and the tax implications of that to only then try and flow it back into the business in most cases. So in the cases where that cash flow is happening within the business, then we want to be structuring policies within there. There's also in Canada in particular, it's a little bit different in the US, but in Canada in particular, there's some very significant tax advantages for having corporately held policies in terms of what's called a nominal account, which is a capital dividend account, and how that works. And we won't go into that in the purview of this conversation, but there are many reasons why it would make sense to use it within the business, and especially as the cash flows are going through there, and the tax advantages also in terms of retained earnings. So if a corporation is very profitable, there are some other tax considerations as well in terms of using whole life strategy within the business, as well as just like the level of protection that it provides the corporation should something happen to one of the key people within the business.
Yeah, I think one thing that's really important that we don't often talk about, but so participating whole life insurance is a tax-exempt product. So it has a lot of tax efficiencies and tax advantages. The capital dividend account is one that is enormous for business owners in Canada, but there are others. And it's important to know that it's part of the tax code. It's not an exception to the tax code like the registered plans that the government has created for us. So when we think of tax efficiency and tax effectiveness, participating whole life insurance is an excellent alternative to some of the other places where you might put your money that is much less tax advantage. So right now in Canada, we're coming up on our RRSP deadline at the end of this month. So there's a lot of marketing to people to dump as much money as they can into their registered plans. And they're doing it for the short-term tax break, not always considering the long-term impact that might have on them and or their business. So those, tax efficiency is another aspect that we can't get into here, but is very, very important, especially for business owners.
I think whenever we have the opportunity to work with business owners, I like to make the statement that, a properly structured dividend-paying, participating whole life insurance policy is likely the single best asset the business can own. And so there's lots to unpack in there to understand it, but this is an incredible asset. And as has been pointed out, there are many advantages and efficiencies that simply aren't available in any other vehicle. And so for a corporation to own this inside their structure, there are many, many advantages, and it's also beneficial to own them privately. And so weighing that out and assessing what works best in any situation is imperative.
Okay, great. We actually have a question, an excellent question from one of our listeners, Jacob, that I'll relay. So my apologies, folks, for those who tune in. I should have probably clarified at the outset that with all these spaces, if you have a particular question, go ahead and post it, and we certainly would like to field your questions on the fly here. And probably we'll wrap up with this particular question, and Jackson will come back in and close us out after our panelists weigh in on this. So the question from Jacob, I'm going to paraphrase it a little bit, goes like this. So, suppose we have somebody who's far away from retirement age, maybe somebody in their 30s, let's say. Why wouldn't an optimal strategy for that person to be to go ahead and take their savings, whatever it is, and just put it into the stock market, which presumably is going to have, higher expected rate of return over the long haul than a whole life policy. But then, as you get older and you start approaching retirement age, then you start funneling, siphoning it out of your stock market funds into a whole life policy to make the transition where, in your later years, you don't care so much about the expected growth rate. You care more about the certainty of it being there. But when you're in your 30s, don't you just kind of want to, put it into something that's going to have the best prospects for long-term growth? So how would you guys respond to something like that?
Yeah, the great question. So my response would be do both. So participating whole life insurance is an and asset. So it's one of those things where we can do this, and this, and this. It's not an or. So you don't have to pick investing in the stock market or putting money into a whole life policy. because we can use the whole life policy for investment purposes if that is what you choose to do. And your returns will be much greater because now you have two assets that are growing equity and value and potentially providing income. So it's an and, not an or. You also want the long-term growth inside your whole life policy as well. Someone else wants to weigh in?
Yeah, I think, that's similar to what I was going to say, is that this is an and asset. So there's also, it's also an insurance product. So just to be aware that not everybody remains insurable for the whole of their life. So you want to make sure that that is not an issue. And generally when people are younger, it's usually, less of a concern. So certainly having some kind of insurance in place to make sure that you can have that option later on in life. But, aside from the insurance side of it, the ability of, combining these really smooths out the fluctuations that you will experience in other types of investing. So, Bob, I'm sure you can speak to that more, but, just really sort of softening the lows and strengthening the highs is sort of the very sort of layperson way of saying it, in terms of having this asset that's also guaranteed growing and ongoing, and that your money's, working hard for you at the same time. And as, I think we're all aware of the benefits of time and compounding. And so to really capitalize on that benefit, if you have the opportunity to do that, I meet people all the time who wish they knew about this option when they're in their 20s and 30s, and understand that they'd be in a very different financial circumstance if that was the case. So, I think there's an opportunity to do both for sure.
The only thing I would add is my common obsession, and that is capital. Understanding the 30-year-old has $100,000 of capital he wants to do something with. He's going to throw it in the market and put it at risk in return for a high return or speculatively high return. And I'm saying, boy, you put your capital at risk. Capital must never be put at risk. Capital must never be given away, exploited, lost, or allowed not to work for you. So by, first of all, securing your capital in a safe place, an alternative place like a properly structured policy, and then put it out to the markets. If the markets perform extraordinarily well, you just replenish your pool and move on. If the markets don't perform really, really well, you have a variety of options to consider on how you're going to replenish that pool over the next 30, 40 years. But your capital has never been put at risk, and therefore your growth is compounding and working for you every day. So it really is an and asset.
Okay, so great. Thanks, everybody. So as I think this discussion has revealed, there are a lot of nuances when it comes to not just getting a policy of this nature, but then how do I design it specifically? What numbers should I use? So forth. And so again, we encourage you, if you're intrigued and want to see more about what would this look like in my situation, go ahead and look at that pinned tweet. We've got, again, different links depending on whether you're in Canada or the United States, because the rules are somewhat different, and that does affect, the optimal policy design you'd use in either jurisdiction. So with all that, thank you everyone for tuning in. I'm going to hand the reins back over to Jackson.
Thank you, Dr. Murphy, George, Wayne, and Liz, for such an incredible conversation. I know I took home so much insightful information. I'm going to have to listen to this recording a couple times myself. And seriously, this has been a great discussion. For those of you that have been tuning in, we hold a weekly Twitter space on Tuesdays at noon Eastern, 10 p.m. Mountain Time, or 10 a.m. Mountain Time. And during these spaces, we alternate topics. We go between our whole life Twitter space, just like this, where we're talking about different topics within the whole life industry and infinite banking. And then next week, our topic will be on real world asset tokenization, where we're bringing in guests from around the industry that have incredible expertise and insights, and really help us dive deep into those narratives and explore that side of Infineo. And so again, thank you to our panelists, Dr. Murphy, George, Wayne, Liz, and all of our listeners. And we really, really hope to see you on a call soon or on our next Twitter space. Thanks for joining.